Hello everyone, my name is Adam Matuzak and this is my research project for this semester. While all banks share the fundamental goal of generating profit for their business and stakeholders, national banks and state banks complete this objective through different strategies shaped by different regulatory frameworks. These variations influence how each type of bank structures its operations, delivers services, and manages compliance. In my opinion, neither model is definitively better. The differences reflect preferences in how profit is achieved and what services are offered. National banks often operate under federal regulations, while state banks are guided by state-specific rules, creating unique approaches to operations and generating profit. This project will explore these contrasts in depth, looking at regulations, strategies, laws, and financial statements. By looking at the two, you will be able to see the strengths and weaknesses of each type of banking. No matter what type of bank is operating, nationally chartered or state chartered, there are specific regulations that each bank must follow. There are 6 types of regulations that seek to enhance the net social benefits of all commercial banks that serve as communities, which are safety and soundness, monetary policy, credit allocation, consumer protection, investor protection, and entry and chartering regulation. Safety and soundness regulations are broken into 5 different layers of protection. The first layer are the regulations to protect depositors and borrowers against the risk of commercial bank failure, such as lack of diversification in asset portfolios. The second layer concerns the minimum level of stockholder capital or equity funds that the owner of a commercial bank need to contribute to the funding of its operations. The third layer is the provision of guarantee funds like the Depositor Insurance Fund, DIF, for banks. The Federal Deposit Insurance Corporation, FDIC, monitors and regulates participants and guarantees deposits of up to $250,000 per depositor per bank. The fourth layer of protection involves monitoring and surveillance, such as on-site examinations and off-site examinations with commercial banks' accounting statements. The fifth and final layer is that regulation is not without cost for those regulated. The cost of an examination may differ, and regulators may require commercial banks to have more equity capital than private owners. Monetary policy regulation is another regulation that applies to all commercial banks. While the Federal Reserve controls the quantity of notes and coins in the economy, called outside money, the bulk of the money supply is with bank deposits, called inside money. Regulators commonly implement reserve requirements that make the control of the money supply and its transmissions more predictable. Credit allocation regulations support commercial banks' lending to different important industries such as housing and farming. These regulations may require a minimum amount of assets in one sector of the economy, or it may set maximum interest rates, prices, or fees to certain sectors. Credit allocation regulations are normally stricter with savings institutions. One of the largest areas of regulation is the consumer protection regulations, starting with the Community Reinvestment Act, CRA, and the Home Mortgage Disclosure Act, HMDA. These regulations were created in the late 1970s to prevent discrimination by any lending institution. CRA regulations include commercial banks needing to submit reports that summarize their lending based on the geographics that show the relationship between the demographic area and the demographic data, like income and minority population percentage. HMDA mainly prevents the discrimination based off age, race, sex, or income. The Consumer Financial Protection Bureau, CFPB, protects consumers against all financial institutions from unfair, deceptive, and abusive practices. For example, in September 2016, Wells Fargo Bank had to pay the CFPB $185 million in fines, which was the largest penalty the CFPB has ever given, due to the violation of consumer rights. Wells Fargo employees were involved in a widespread illegal practice of secretly opening unauthorized deposits and credit card accounts. Employees were opening these accounts to try to meet the bank's sales goals. Investor protection regulation includes a number of laws to protect investors who use commercial banks directly to purchase securities and/or indirectly to access security markets through investing in mutual pension funds managed by commercial banks. Mainly, these laws are to protect investors against abuses like insider trading, lack of disclosure, malfeasance, which is intentional commission of an illegal or wrongful act by someone in a position of authority, example of the Ponzi scheme, and breach of fiduciary responsibilities. Entry and chartering regulations are just as they say. These are regulations for the entry into the commercial bank industry. The cost of entry may increase or decrease depending on the effects of the profitability with the firms already competing in the industry. Commercial banks are heavily protected against new entrants by high direct and indirect cost, making it more difficult to enter the commercial banking industry. Nationally chartered banks operate under federal law by the National Bank Act of 1864. This act established many federal banking regulations and created the Office of Comptroller of the Currency, OCC, which enforces and supervises the federal regulation. Being a nationally chartered bank has its benefits, and one of those is that being federally regulated, it creates a standard, uniform set of laws. So, unlike state banks, national banks have the same set of laws and regulations they must follow. Being uniform creates more efficient, understandable work and community environment. With the rules being uniform and consistent, that also means they are strict. The disadvantage for national banks, while it applies to both, is that these regulations need to be upheld to a very high standard, and falling short can result in major consequences. National banks can apply interest rate laws from their home state bank to borrowers across the country. This can be a big advantage depending on what state they originated from, since state banks must follow the regulations on interest rates according to their state. Another advantage of national banks is that they are more widespread than state banks. National banks are allowed to operate in any state in the nation, which means more branch locations, more ATMs, which make it more convenient for customers. Some national banks even operate in other countries, while different countries require different regulations. This is appealing to consumers and businesses that travel or operate in those other countries. Since 2021, Nicolet National Bank has expanded to what will be in 5 states outside of Wisconsin. In October 2025, Nicolet National Bank announced the acquisition of Midwest1 Financial Group, Inc., which means they will be operating in states of Wisconsin, Michigan, Minnesota, Iowa, Colorado, and Florida. National banks are allowed to acquire banks anywhere within the nation. State chartered banks' operations vary depending on which state they are located in. Instead of being regulated by the OCC, state banks are regulated by state regulators. Abbey Bank is regulated by the Wisconsin Department of Financial Institutions, WDFI, along with other state banks located in Wisconsin. State banks are also subject to federal regulation and supervision as well, either by the Federal Reserve System, FRS, or the FDIC. Abbey Bank chose to not be a member of the Federal Reserve System, which would determine them as a state non-member bank, also implying that their primary regulator is the FDIC. State banks are limited to only having locations within a singular state. While this restricts the growth ability, they are able to create positive benefits from this. They often benefit from their smaller size because it allows them to stay closely connected to the communities they serve. State banks normally have easy, direct access to local perspectives so they can better understand needs and challenges of individuals and businesses in the community. This allows them to address and help resolve local financial issues more effectively than larger distance institutions. While larger national banks strive to help communities they serve in, it is not as easy if the headquarters are located in a distant area. For example, right on the homepage of Abbey Bank's website, they have an option for anyone to make a donation, which then Abbey Bank will match up to $7,500, and that donation will support local families in the communities that each branch is located in. Overall, the strategy for state banks is to serve local communities and primarily focus on the well-being of those communities they serve in. A method was adopted by the Federal Financial Institution Examination Council, FFIEC, to evaluate commercial banks' financials, which is known as the CAMELS rating. The CAMELS rating is rated on a scale from 1 to 5, 5 being the worst rating and 1 being the best. I'm unable to complete a CAMELS rating because it requires sensitive and confidential information, but I will briefly touch on it. C stands for capital adequacy, A stands for asset quality, M stands for management, E for earnings, L for liquidity, and S for sensitivity to the market. Each parts are rated on a scale from 1 to 5 and is weighted by percentage and then given an overall rating. Without being able to complete a CAMELS rating, another way to evaluate a commercial bank is through solely their financial statements. In my opinion, one of the most important financial ratios to look at is the net interest income. Commercial banks earn the majority of their income from interest off of loans. This graph from UBPR shows both Nicolet National Bank's and Abbey Bank's net interest income. This data shows quarterly net interest income using the amount. It seems that both of these banks have similar trends throughout the quarters, throughout the years. Nicolet National Bank and Abbey Bank both show steady increase in interest income. This tells us that the well-being of lending is healthy and there is nothing to be concerned about. The only difference is that Nicolet National Bank generated more income than Abbey Bank, which can be related to the size of each bank. This does not determine that one bank has outperformed the other. Net income is another strong measure for evaluating the financial well-being of banks because it reflects their overall profitability after accounting for expenses, taxes, and loan losses. This is different from revenue because revenue only shows income generated, where net income shows efficiency in managing costs and risks. Net income also indicates how well a bank balances lending, investments, and operations to generate positive returns. The graph from UBPR shows the net income for Nicolet National Bank and Abbey Bank. It displays all the quarterly net income amounts from the end of 2023 to the end of September 2025. Once again, you can see that both banks have the same sort of trends. Beginning of the year normally shows a decrease in net income, but then continuously increases throughout the year. While Nicolet National Bank, being a larger bank than Abbey Bank, they reflect larger net income. After looking at both of these set of financials, it is clear that both of these commercial banks are showing the same trends, with Nicolet National Bank being on a larger scale because of their size. It doesn't seem like one of them is specifically outperforming the other one based off the fact that the trends over each quarter are identical. With the overall goal of generating profit for their business and stakeholders, we can see that each strategy somewhat leads to the same outcome when comparing Nicolet National Bank and Abbey Bank. In my opinion, neither model is definitively better than the other. The differences reflect on preferences in how profit is achieved and what services are offered. National banks often operate under federal regulations and create opportunity to expand more, while state banks are guided by specific rules, creating unique approaches to operations, finding ways to help local financial needs, and generating profit.